While I'm Jagender Rana, topic of the day is rating criteria for general insurance companies. Rating criteria for general insurance companies. A general insurance company is raised capital through subordinated debt or preference shares called hybrid instruments to augment common equity. This helps them maintain the required solvency ratio. So the criteria for rating these instruments is to be understood now. The starting point for rating the hybrid instrument is the counterparty credit risk rating of the GIC. The criteria for the counterparty credit risk, that is CCR rating of GICs, are detailed and given here. So the rating of hybrid instrument issued by GIC is either equated to or notched down from the CCR rating. So the criteria for the notch down are also detailed here. So the rating focuses on critical aspects for the insurance business under the Indian regulatory framework. The insurer's ability to meet its obligations to the policyholders is assessed on the basis of the certain parameters. There are several criteria to arrive at the rating, including the analysis of the company's policies, practices, performance of management, projected business and plans and financial analysis, industry and business risk analysis, risk management systems, investment management, use of technology, marketing distribution channels, and parental and recapitalization support in the case of new companies. So following key parameters are here. Competitive positioning of the entity, that is market position of the entity, diversity of products offered, nature of products offered, net retention ratio. Then enterprise risk management capabilities, diversity of operations of the entity, risk management policies and systems, reinsurance risk retained in high risk products, reinsurer risk, regulatory risk, and financial risk, capitalization of entity, capitalization ratio, solvency ratio, growth and infusion plans, financial flexibility, underwriting performance, combined ratio, claim ratio, expense ratio, underwriting surplus, operating profits, profitability trend, liability side risk, the fundamental risk arising out of underwriting and reserving, and asset side risk, potential losses arising out of credit risk, market risk, liquid securities valuation, among others, and asset liability management. Then there is management strategy, risk appetite, competence, and integrity. So as far as competitive positioning is concerned, business growth in the general insurance companies depends a lot on its competitive positioning in the market vis-a-vis its peers. Rating analysis of the company agencies is insurer's source of competitive advantage as well as its overall microeconomic business profile, with the aim of evaluating its long-term revenue generating capability. Key points considered are as follows, like companies' competitive strengths and weaknesses, quality and spread of distribution channels, diversification of business mix by geography, sector, line of business, distribution source, Then growth rates of premium in total and by line of business on both net and gross base, generally over 5 years. Market share overall and by major lines of business. Related non-insurance activities, if any, then net retention of customers every year. The diversity of product is an important factor not only for the insurer to be the preferred choice for customers, but also for assessing their relative risk profile, given that each product has a different risk profile. Then comes enterprise-wide risk management. So the insurer's effort to align the risk strategy with the business strategy is analyzed. On ERM, that is enterprise risk management practices, will be assessed relative to the realistic level of risk at the company and relative to peers with similar risk. So this is evaluated in EWRM quality in the following areas: risk management culture, risk controls, competitive positioning, then extreme risk management, strategic risk management, and risk management policies adopted and systems implemented to control risks. So diversity in location, customers and products constitutes the means through which the insurer manages its risk. In addition to assessing the internal portfolio risk controls, agencies assesses how the insurers manages its risk through reinsurance taken for its high risk products. Lastly, agencies also assesses the regulatory compliance followed by the insurer. Then there comes the capital adequacy. Solvency is the most important measure of an insurer's ability to continue to service its policyholders and debt holders and continue to grow. Solvency is ensured through the adequate infusion of funds to maintain the capital in the entity. So insurance regulator requires insurers to maintain a solvency ratio, available solvency margin or the required solvency margin of 1.5 at all times. So in addition to the current solvency ratio, the growth plans of the insurer and capital infusion plans, along with its financial flexibility to infuse funds, are important factor considered. Finally, the capitalization ratio, that is net premium written to net worth, is also considered to assess the risk undertaken by the insurers against the capital cushion it carries. Broadly, the assessment covers the following areas: capital cushion available to support policyholders' obligations and other liabilities, balance sheet strength, solvency profile of the insurer, then insurer's potential need for additional capital in the future, and the sources that may be available to meet this requirement. Sound underwriting policies and practices make up the foundation for the long-term sentences of insurance company, long-term sustenance of the insurance company. While insurance companies make significant investment income, the core profitability needs to come through underwriting surplus, which is dependent on the sound underwriting practices of choosing the right risk level customers and pricing high risk customers appropriately. So the efficiency of underwriting is analyzed through assessing the insurer's underwriting surplus, combined ratio, claim ratio, expense ratio, operating profits, and the trend of profitability over the years. Underwriting surplus is a measure of gross surplus available after incurring the claims, paying commissions, and operating expenses. The claim ratio is the ratio of claims to premiums, and expense ratio is the ratio of expenses to premiums. The claim ratio is the ratio of claims to the premiums, and the expense ratio is the ratio of expense to the premiums. This indicates whether the premium pricing adequately takes into account the possible claims and operating expenses. The combined ratio is the sum of the claims and expense ratios. So these ratios can be volatile, and hence a trend of profitability is required to establish the true profitability of the insurer. So on the asset related risk, agencies review the investment policy and portfolio of the insurer. A detailed analysis is done to understand the processes followed by the company to manage market risk, credit risk, and so on, and its investments. The diversification in the investment portfolio into different industries, single name concentration limits, and distribution across rating grades is studied. So the asset liability management focus area includes the following, that is interest rate risk, and asset liability duration gap analysis, asset allocation strategies, asset credit qualities, and asset diversification by asset class, sector, maturity insurers, portfolio liquidity. Then comes management and corporate strategy. So the quality and credibility of an insurer's management team is a key determinant of the company's success. Agencies would meet the senior management to understand the risk appetite for the future growth strategy and implementation plan. These criteria outline the methodology to arrive at the standalone rating of general insurance companies. The rating further considers any support that the general insurance company can get from its parents or group. The public sector general insurance companies are also assessed for the support they enjoy from the government. The parents' support is especially key in the initial years of growth of general insurance companies, where the profitability will not be sufficient to support growth in business. In such cases, the standalone rating of the general insurance companies gets notched up, and the extent of the notch up is driven by agencies' criteria for notching up the standalone rating of entities based on parents or group or government support, which can be found on the agency's website. So the rating criteria of general insurance companies are for the CCR rating. The criteria for rating hybrid instrument issued by GICs are different, because the hybrid instrument issued by general insurance companies are either perpetual or have a maturity of 10 years. They have a call option at the end of 5 years and a no put option. So to service interest, pay dividend, and for principal payment, the general insurance companies has to maintain its solvency ratio above the regulatory minimum of 1.5. So in the event of general insurance companies making a loss, approval from the IRDAI is required for making the interest or the dividend payment. While subordinated debt instruments are cumulative, and so any defaults can be cured later. Preference shares are non-cumulative and a default cannot be cured. The features of hybrid instruments are similar to those of upper tier second bonds issued by banks, and the rating criteria mirror the criteria for upper tier second bond issued by banks. The rating of the hybrids could be equated to the CCR rating of the general insurance company if it maintains a high cushion in the solvency ratio over the regulatory minimum and is expected to continue to maintain the cushion. This is typically true for general insurance companies with strong parents and hence a high financial flexibility. Agency expects general insurance companies to receive the IRDAI permission to service interest for subordinated debt instruments even if the GIC makes a loss. So the solvency ratio is 1.5. Our profitability is a factor considered in deciding the notch down from the CCR rating. So for low to no cushion in the solvency ratio and an entity making losses, the rating of hybrids could be up to 4 notches below the CCR rating. So the preference shares, in addition to the solvency ratio and profitability reserves availability to pay dividends, are also assessed to arrive at the possible notch down in the rating. So agencies have a Securities and Exchange Board of India registered credit rating agency and accredited by Reserve Bank of India, offers credit rating of bank loan, non-convertibles, convertible, partially convertible debentures and other capital market instruments and bond. So these criterias. See, a credit rating agency assesses an entity or a specific security or money market instrument and provides a forward-looking independent opinion on the entity of issuer's ability to meet its financial obligations in full. So the precursors of today's rating agencies were first established in the wake of the financial crisis in the mid-1800s, where they rated merchants' ability to pay their debts and consolidated those ratings in published guides. Today, rating agencies continue to serve a similar purpose to provide transparent and relatively simple and comparable terminologies to describe the different levels of creditworthiness across industries. The rating agencies provide macroeconomic insights, sector thought leadership, and outlooks on a regular basis. So as of December 2022, the US Securities and Exchange Commission has designated 10 organizations as a nationally recognized statistical rating organization. So the Securities Exchange Commission monitors the activities and conducts examinations of registered nationally recognized statistical rating organizations, that is NRSROs, to assess and promote compliance with the statutory and SEC requirements. So they are AM Best Rating Agency, DBR Inc., Damatec Inc., Egan Jones Rating Company, Fitch Rating Company, HR Rating de Mexico, Japan Credit Rating Agency Limited, Kroll Bond Rating Agency Inc., Moody's Investors Service Inc., S&P Global Ratings. So within the insurance industry, rating agencies assess different types of credit ratings depending on the intended use. There are generally two types of rating relevant to insurance companies. A, financial strength rating, that analyzes an insurer's ability to meet ongoing policyholders' claims and contract obligations, which is dependent on the availability of sufficient assets as well as an appropriate amount of liquid assets. And secondly, an issuer's or issue credit rating looks beyond the claim paying ability and reviews the relative future credit risk of an entity or specific obligations as they come due, considering the obligation's seniority. It can be issued on either a long or short term basis. So rating agencies evaluate both single legal entity insurance companies and insurance groups with diversified insurance and non-insurance operations. Rating agencies may assign a rating for the individual insurers following a combined assessment of the single entity along with the adjustment for holding and other non-insurance companies, or they may determine a rating for the largest insurer within the group or a consolidated rating for the insurance groups. Thank you. Thank you very much.